Bond issuers. Most bonds are issued by governments, including the federal government, state governments, and local governments. Many large corporations also issue bonds. Why would a government or corporation want to go into debt to bondholders? When an organization needs money, it can issue bonds to get it. But why not get a bank loan instead? Bond issuers put themselves in debt to bondholders so they can fund their activities on their own terms. Bonds help governments cover major expenses and undertake important public projects, such as building roads, schools, and airports. Bonds help companies build factories and expand operations. In general, bonds help bond issuers meet their financial goals without going into debt to a bank. Types of bonds. There are three major types of bonds: U.S. Treasury bonds, municipal bonds, corporate bonds. You can watch the slideshow to learn about the three major types of bonds. Who can be trusted? Bonds are relatively safe investments, but there is still the possibility of default. Even big corporations occasionally go out of business, and some foreign governments have been forced to cancel their debts. It is important to know which bond issuers are reliable and which pose a risk to bondholders. Every bond issuer is given a bond rating by private investment firms such as Moody's Investors Service, Standard & Poor's, S&P, and Fitch Ratings. Some bond issuers, like the U.S. government, can be relied upon to pay back the debt. Since the United States has an extremely low default risk, it typically enjoys a high bond rating. Still, as a result of political budget battles among U.S. lawmakers in 2011, S&P downgraded the U.S. government's bond rating from outstanding, or AAA, to excellent, AA+. The best bond rating is AAA. The worst bond rating is either a D or a C, depending on the rating agency. Bonds with low ratings are sometimes called junk bonds. Junk bonds are issued by borrowers who are in financial trouble. Because they are so risky, they offer a high yield to make the risk worthwhile and attract investors. Investors can make a lot of money on junk bonds, but only if the bond issuer does not go out of business or default on the debt. The bond market. Like the stock market, the bond market is split between a primary and secondary market. The primary bond market is where bondholders buy the bonds directly from the issuer. The secondary bond market is where bonds are bought and sold by investors. The secondary market is typically more active than the primary market. While some investors buy bonds in the primary market and hang on to them until maturity, most investors buy and sell bonds on the secondary market, trading them before they reach maturity. Prices. A bond's price is not the same as its face value. Remember, face value is the amount the issuer has agreed to pay when the bond matures. When you buy a bond, the price you pay may be equal to face value, more than face value, or less than face value. If you buy a bond for more than face value, you got the bond at a premium. If you buy the bond for less than face value, you got it at a discount. Bond prices in the primary market are set by the issuer. Usually, the price is set at face value or at a discount to entice buying. In the secondary market, bond prices are determined by the market. The price of bonds in the secondary market could be either more or less than the bond's face value. Prices in the secondary bond market are governed by the law of supply and demand. If there are more bondholders selling bonds than investors buying them, supply exceeds demand and prices go down. If more investors are demanding bonds than there are bondholders selling, supply is low and prices go up. Key factors that influence supply and demand include expectations about interest rates and inflation, the bond's face value, the maturity date, and the bond rating. Rate of return. Price is not the only thing investors need to know about when they purchase a bond. A bond's yield is also important. Yield is the rate of return on an investment. The yield on a bond purchase in the secondary market is not fixed the way the face value and coupon rate are. Yield changes with the price of the bond. The current yield of a bond is the coupon divided by the price. When you buy a bond for face value, the yield is the same as the coupon. That is, the yield is the same as the interest rate. But when you buy a bond for more or less than its face value, the yield is no longer equivalent to the coupon. For instance, think of an investor who buys a 30-year bond with a face value of $1,000 and a 6% coupon. The yield is 6%. That is $60, which is 6% of $1,000. Now, that person sells the bond on the secondary market, where another investor buys it for $800. What will the yield be for the second investor? Remember, the coupon attached to that bond is still 6% of its face value of $1,000. Since the price of the bond is less than face value, the yield is higher, in this case 7.5%, because 60 is 7.5% of 800. If that second investor had paid $1,200 for the bond, the yield would have dropped to 5%. $60 is 5% of $1,200. Prices and yields move in opposite directions. If price is greater than face value, yield drops. If price is less than face value, yield rises. Risky business. Bonds have the reputation of being safe investments. While bonds do offer guarantees of payment, there is no such thing as a completely risk-free bond. Lenders always face risks, and guarantees can be broken. Bond ratings help investors choose their bonds wisely, but even this system is not foolproof. Watch the slideshow to find out about the main risks bondholders face. The advantages of bonds. Bonds are usually a conservative investment with advantages over other investments, and they should be given serious consideration as an investment option. The secondary bond market, like most financial markets, poses certain risks while promising high returns. Test your knowledge of the bond market and complete the drag and drop, or complete the little bond market activity right there. So that concludes 4.06 More Markets 1, and the next recording will be of 4.07 More Markets 2. As always, let me know if you have any questions. Have a great day.